So we are running behind, but I do want to give this next panel a full hour. So for certain, we'll take them to 4:30. Unfortunately, we'll just run into Remy's panel a bit. So, but next up is I kind of had a little fun with the title, but unfortunately, the beast that has become workers' comp is very real to a lot of people. A lot of small trainers. I've talked about this in small business administration groups within the U.S. Chamber of Commerce. Workers' comp for any small business has become a very difficult thing to overcome. And so it's important for us to understand it and the unique nature that they actually have here in Louisiana. We're fortunate to be here for a lot of different reasons, but to have Ed Finansky and his crew talk about this will be very beneficial to all of us. So I'm going to do a very brief introduction, titles only, so we can get the panel up here. As I had mentioned, our moderator is going to be Ed Finansky, the Executive Director of the Louisiana HBPA. Next we have Mr. Michael Lyon, co-founder of Finish Line Self-Insurance Group. We also have Mr. Charles Caldwell, Chief Executive Officer of Midlands Management. Mr. John Duviel, Partner, Jones Walker Law Firm. Mr. John O'Brien, the Area Director of Program Insurance with Arthur Gallagher Risk Management. And last, Mr. Weston Griffith, Chief Business Officer for the Self-Insured Solutions and Loss Prevention Specialist. So while they're getting settled, just as a point of convention notes, tomorrow's buses to the racetrack will arrive at 1 o'clock. So if you could meet in the lobby at 1 o'clock. The plan is for the buses to come back between 5:30 and 6. And one last mention, if you we have some gift baskets this year. If you look in the back of your convention book on the Save the Dates page, if you have a sticker, hang on to that book because you may be a winner. You have a 1 in 6 shot of getting in there. So hang on to those if you've got the book, and if you didn't get a book, run out in the hallway and try to get one. So I'm going to turn it over now to Ed, and again, thank you for a wonderful convention.
Good afternoon, everyone. I'm Ed Finansky, Executive Director of Louisiana HBPA, and what we're here to talk about is our workers' comp program, and then some of the gentlemen here can also expand upon not only the program here, but the one in California that's currently in place. In Louisiana, in the early 2000s, the workers' comp rates just started to skyrocket. And our entity worked with the legislature and got a program put in place where, we get a supplement from the purses of 1%. If you come to race in Louisiana, you must use our program. That's another key aspect of it. And they launched a program that was a captive program. And that did a very good job for the horsemen for a while. And then that structure ran into a little bit of a problem. So we had a little bit of a hiccup. We went back and talked with the Louisiana Department of Insurance and some of the legislators, and they were very helpful. And we're currently a self-insurance trust is how we handle the workers' comp insurance. And I'll throw it over to John O'Brien and Duvial to kind of give you a little background of just what that self-insurance trust structure does for us.
Yeah, I'm John O'Brien. I'm with Arthur Gallagher, and we helped design the trust that the workers' compensation program is, along with John Duvial, who actually put the trust together. The trust is a much lower cost structure than what the captive was. And we worked with the Department of Insurance, which was essential, who approved the trust as a mechanism to distribute the workers' compensation to all of the trainers in Louisiana, and those trainers that came into Louisiana. The trust doesn't require fronting, and it doesn't require as much collateral, and so from the point forward, from 2011, when it was established, we've saved just hundreds of thousands of dollars in cost versus a captive. And John was instrumental, Duvial, the attorney, in helping design the exact trust that the workers' compensation program went into, and I'll pass it over to him, and he can give you information about the trust.
Yeah, we were faced with a situation where workers' comp benefits and the costs for trainers was getting prohibitive, and as a result, it was being reflective on owners because the costs get passed down. The problem we had with the captive is that the rate per dollar or per $100 was going up exponentially with no end in sight. So an animal had to be created, if you will, and the trust was the way to do it, and we actually used we were lucky enough to have a means and a mechanism under Louisiana trust law to create this. And our insurance commissioner was very accommodating. But what was essential is to get the funding for that trust. And we were fortunate enough to work closely with the legislature in one part, and then the other part was to make it mandatory participation, which then allows us to collect monies to fund the trust and to provide the compensation coverage. And by being mandatory, you can't opt out unless the trust decides they don't want you, if you're just a bad claim or what have you. But the biggest thing is that the amount that we charge was based on per start as what was done before, but that allows us to be funded completely. And then we're lucky enough to also cover farms in Louisiana. And then we've made what we call an out-of-state program, depending upon the trainer's participation in Louisiana. So we've been very fortunate so far. The biggest thing about the trust and it doesn't require any upfront money to put on the table. So if you run it right and you can build up reserves and you do your homework and you have people who understand it's a privilege to be included in this trust as opposed to being mandatory, they're very receptive to it. We've had some bad boys and bad girls, and we've had to put them on probation and raise rates, and they just like children. They all of a sudden get a whole lot better because the alternative is basically double of what our rate is. So as a result, we're the parent and we watch them. We inspect places, we do audits on farms, we check trainers, we check training facilities, and it's all documented. We have a special trustees group that deals just with workers' comp. So we undergo a lot, but the biggest thing that we're the most proudest of is the state of Louisiana, because of what we are. We've undergo how many audits?
Six audits annually.
We undergo 6 audits a year by the state of Louisiana, and we've been pricked and probed like we've been in a hospital, and we are very honored and happy to report that we pass our audits. So with that,
The people next door, I mean,
Yeah.
without the excess insurance, which Midlands Management provides, and they provide it all over the nation, it's the key to, once you put your structure together, let's say you do a trust or whatever it is, you have to buy that reinsurance to make sure that you'll be financially solvent.
And John, that's what I want you to ask you to go through. Can you go through how we are the first layer of insurance?
Right.
And then we've dealt with
Right, so
Midlands.
you have to go through a feasibility study and figure out, how much premium to risk that you have, and then you sort of pick a deductible as the easiest way to start out a program like this. And that deductible can start out at, $100,000 per claim up to, right now, we're at $500,000. But over that claim, you have to have insurance in case you get the catastrophic type of claim, the paraplegic or whatnot, so that the trust doesn't go insolvent. So you have to procure insurance, and Midlands Management and Charlie Caldwell came to the table 5 years ago and has been doing trusts for years, and he's the best that we've had, and he's been the most stable. And so you need that excess insurance, which they provide, and Michael, who runs the Finish Line in California, has almost a similar type of structure, and it can be done in other states. It's a matter of, getting your Department of Insurance together, doing your feasibility study, getting with your legislature, getting that funding. And I think Michael can go through what's happening in California in the Finish Line, and he works, again, very closely with Charlie Caldwell. You got two.
Stereo. I want to thank you for inviting me to attend today. I appreciate the opportunity to share the California experience. We were seeing similar increases in premiums that were happening in Louisiana, but our rate got up to $60 a hundred for the backstretch workers, the grooms, the hot walkers, the exercise riders. And you might as well have been in the roofing business back then as a horse trainer. And basically it was running all the trainers out of California. So we came up with the idea of forming a self-insurance group, and we initially formed it just for the quarter horse racing in California, because the thoroughbreds at that time had gone off and formed a captive, similar again to the experience here. And so we started our captive in 2005 with just a quarter horse, and we operated it up until 2011 as exclusive coverage for the quarter horse industry in California. It's a very successful program. It's had equity in almost from day one. Some of the differences in California from Louisiana is we're a self-insured group. And that is a group of people in a similar industry, i.e. horse trainers, who come together to form the group. And the group is a non-profit, mutual benefit, tax-paying company. So although we're non-profit, we do have to pay taxes on any surplus we may have. So that's kind of a be damned if you do, damned if you don't kind of a situation. Actually, it's the IRS. Besides paying taxes and being nonprofit, we still have a strong bottom line. It was the solution for the quarter horse industry. Otherwise, the quarter horse industry would have been dead in California. At the time, the regulations in California called for there to be a founding member of the group. And the founding member had to have a net equity of $5 million and have $500,000 of profit per year. As you know, there's not many trainers in the world that have $5 million of equity and $500,000 of profit a year. So the owner of Los Alamitos, Dr. Allred, stepped forward to be the founding member for the quarter horse industry in California, and that's how we formed the group. The thoroughbreds came and joined the group in July of 2011 because their captive, once again, much similar to here in Louisiana, fell apart. They went from a captive to a guaranteed cost program with a small insurer by the name of Companion. Companion went belly up on them within a year. So they came to us in July of 2011 and asked, can we join your group? And we welcomed them with open arms. They formed an alliance with the quarter horse industry, which was kind of unheard of in California. It's always kind of been stepchild situation for the quarter horse. But they honored the fact that they could join Finish Line. They were active members of Finish Line up until July of last year, at which time the regulations in California changed, and you no longer had to have the founding member with the big bucks. So we were able to spin off the thoroughbreds from Finish Line group into their own group, which is what they really wanted. They wanted to control their own destiny. And they no longer had to have the big daddy. They just had to be able to prove that they could be financially self-sustaining. And they did that through the feasibility study that John talked about. And they've been in operation since July of last year. They finished 6 months with net equity in the company and a small profit. And we don't operate it to make a profit. We operate it to service the horsemen in California. So a profit is just a benefit, and it just increases the equity of the program and ultimately allows for either a dividend to the members or a reduction in premiums. As far as our premiums in California, we've only increased the premiums one time since our inception. Well, I'll take that back. Since July of 2011, the premiums only went up once in all that time for the horsemen. And it's the way to go for the horse racing industry because you're controlling your own destiny. You are the company. The trainers in California are the members. The trainers are on the board. They're the governance. They're the ones that determine the underwriting policies. They set the standard. And they all realize the benefit of the group, that it's a privilege to be in the group. It's not a right. It's a privilege to be in the group because it's saving them hundreds of thousands of dollars in premiums. Bob Baffert is in the group. He's the president of the post-time group. His premium would be 10 times what it currently is, and I don't know if he'd be in California right now if he had to go to the state fund. And the gentleman, pardon me? Yeah. The gentleman sitting next to me is a big factor in the success of our organization. If it wasn't for Charlie and his belief in the program and providing us with the excess coverage, we wouldn't be in existence because you have to have access in California. You cannot take all of the risk yourself. And we take the first $1 million of risk in California as opposed to the $500,000 here. So I think that's about all I have for California, and I'm going to let Charlie speak his piece.
Thank you very much, and thanks for the invitation to be here. Our company is Midlands Management. We're located in Oklahoma City, and we are excess workers' compensation underwriters, and that's our business. And we write excess workers' comp over self-insured groups and standalone self-insureds countrywide. And in our view, the most efficient way for a small businessman, regardless of the industry, to handle his workers' compensation exposure is band together with other people in that industry and form a self-insured group or a trust or whatever that particular jurisdiction allows. And then those members then become, in reality, a purest form of reciprocal insurance company that exists because they do take each other's risk and you operate a small insurance company. And as both of these gentlemen alluded, they operate a very quality operation. They do the underwriting, they do the pricing, and manage the risk, much as an insurance company. With one exception, they really know what they're doing in that particular industry. Some of the large insurance companies will, in occasion, come in and try to ride a trainer or ride a horse racing track or facility, and they're usually gone within a year because they don't understand the business. They looked at the premium size, they came in and soon got run out because they don't understand what they're doing. And even their loss control people don't have that expertise to walk around the stables and help the trainers prevent losses. And that's another key part of the organization. The organization of the SIG, and as these two gentlemen allude to, they either manage their own claims or they have a third-party administrator that manages the claims and under the close scrutiny of the administrators. And that makes a big difference. They're hands-on, and as Michael said, you control your own destiny. And that's very important, and I think that's been the part of what we really like about the self-insured business is that the members, the individual members really have skin in the game. And it's a big thing to go to these board meetings and see the participants and their enthusiasm in working with the administrators on preventing losses and holding premium down. So I would urge each of you, if your state has such regulations that would permit the formation of a self-insured group, that you should certainly consider it. On my right is Weston Griffin of Self-Insured Solutions in Las Vegas, and they administer 8 funds in California, most of them in the agriculture business. But the reason that we asked him here today is he's a loss control specialist specializing in dealing with large animals, from dairies to horses to whatever, and the different problems that brings.
Thank you, Charlie. I'm pleased to be here today, and just wanted to briefly touch on a couple of things that we've seen with our self-insured groups and any kind of fund that we work with. It's really important to have the ownership buy-in. Like Michael said, you know, there's a lot of times that we run into issues where people want to get in the fund, but they don't have the intellectual buy-in. They don't have the ownership buy-in to where they know that, you know, their losses are going to affect the group as a whole. And so it takes a little bit of time to instill that safety culture. And that's what we do. As we come out, we look at the facilities, we walk the facilities, find the hazards, and hopefully identify the hazards that will eventually be eliminated to where losses don't occur. So we want to make sure that we start from the top down, because, you know, as the ownership goes, so do the employees. If it's important to the ownership, it's important to the employees. So we really believe in having a united front, having all the vendors involved, and trying to reduce those work comp costs to the ownership involved, so that they can be profitable and continue to operate their businesses that they're in. So it's our main focus that we identify the hazards, reduce those hazards, educate. Education's a big part. We talked about that yesterday morning at one of the breakout sessions, was really trying to make sure that people are certified in what they do. It provides the employees some legitimacy to what they're doing, and it makes them have that benefit as being an employee at the racetracks or whatever they might be doing.
Well, I just want to expand upon a little bit of what we do in Louisiana. You know, we talked about the fact that it's a mandatory participation. That's a key in Louisiana in order to make sure we capture enough of the pool of risk to have a viable business. You know, if you can't generate enough of a volume, then the financials just don't work out in order to have it be a successful business. We have at each of the racetracks and one of the largest training centers in the state, we have personnel, we have boots on the ground. They work there on the backside, that, as John Duvial alluded to, they're walking the barns, they're trying to identify anything that's being done that would cause additional risk. We know the backside can be a very risky environment, can be very dangerous, but you can also make it less dangerous by having good practices. When there's several hundred horses flying around in the morning at the fairgrounds training, you know, we may pause and hold our breath a little bit and hope, you know, everyone's doing what they're supposed to, but we know that the outriders are doing their job, making sure people have their flak vests on, that their helmets strapped. Our people are looking as they're entering the track or leaving the track to make sure that they're behaving. If not, their trainer's going to get a note that your exercise rider is not properly wearing his equipment. You know, we're constantly trying to identify ways to eliminate any type of hazardous risk that's out there. We're not always successful, but we're doing pretty good with it.
One thing that I think has made our program very successful is in part because of the board that runs the HBPA in Louisiana. Because one part of us is the workers' comp trusts, but we're also the horsemen's group that takes care of the horsemen. So we provide medical services for employees to see, the backside workers to see physicians. They have backside committees and what have you. And the most important thing I think we've developed as a group is that we're not viewed as, quote, an insurance company. We're viewed as part of the solution. And in that respect, I mean, we provide definite benefit to the trainers. We provide a definite benefit ultimately to the owners who are not paying as much costs. But the workers know that we stand there for them through the workers' comp program. Yeah, we drug test them and we put them through what everybody else goes through, but they know that if they do have some type of medical condition that's not workers' comp related, there is a medical physician on the backside to help them. Just as if they do have a workers' comp claim, there's a mechanism for them to be handled. And if you get everybody on the backside having an understanding for each other, you're going to be successful with your program. Sure, everybody up here will tell you, a claim begins usually right when you hire somebody. You hire somebody bad, you're going to get a claim, and that's just the nature of the beast. But when you have a group of people that's the only thing they understand in life is to work with horses, it's very unique because people get injured and people get hurt, but a large majority of them want to come back to do the work, and they want to come back in the horse industry. And it's true, there is limited education, and there might be questions about their lingual skills and what have you, but they love horses, and that's where they want to be. And so as a group, with Louisiana especially, with our group, and Bernard, I'll say this, even though I hate to admit it, he really looks out for the small guys, and I have a big passion for the big guys. And so there's a distinct difference because, you know, to me, I get a small guy with 5 horses, he has 1 groom. I get a big guy who's got 30 grooms, he has 700, 800 starts throughout the year. Dollars-wise, we do much better with the big guy. And I'm not taking anything away from the little guys, but it's just the dollars and cents. And we can't be successful or pay this man over here his premium unless we have starts. And that's goes into your calculations and how we deal it. But we do provide it evenly across the board to everybody, and everybody knows that we do. And we don't pick on anybody except for the bad guys. And we will identify you, and you have to do what's right. And if you don't, your option is to go up in the price or you move on. But, we charge by the start, and I'm very interested in the California approach with respect to charging by the stall, because both ways, I think, are very effective, and depending upon the level of participation will dictate the amount of payment that they make towards the premium, because every day, one person is going to take care of 5 horses, and that's whether they run or they don't run. But our risk is there every day. So if Louisiana or California, whoever's going to insure these people, in order to make certain that we can afford the premiums at their most reasonable costs, there's a level of participation that has to take place. And what we stress in Louisiana is, as long as there's equal participation and people are sincere, we can provide a benefit. And we look for the ones who try to not participate to the level that they should, and those we try to deal with. So.
But either way, the fact that it's a verifiable basis for charging the premium is critical. In this industry, trying to gather certain payroll records proved to be impossible. Accurate payroll records were impossible. But you have to have the verifiable basis to charge the premium, and then you know that everyone is at least on the premium side of it participating to what they're supposed to participate to.
In California, our program is not mandatory. There's only 2 programs in California, ours and the state fund, and nobody wants to go to the state fund because their rates are out of the room. So ours is voluntary participation, but everybody wants in because it's the best deal in town. As far as verifiable information, we cover the backstretch workers and the jockeys. Unlike in Louisiana where the jockeys are excluded from their program. Our premium for the jockeys is $100 per start. And that gets paid directly to us out of the paymaster's account from the owner. On the backstretch workers side, we charge the trainers $3 per stall per day. So basically, it's a $90 a month premium per horse. And if you have a stall and you got a horse in it, we're charging you $3. It's verifiable because the stall manager at the individual racetracks is giving us the information. And we're not asking the trainer from it, but Lordy, bar the door. If you give them too many counts, I'll be there to tell you I only had 8 stalls, and, you know, these are the horses that were in those 8 stalls. So that plays into my next thought, and that is that buying into the program. The trainers buy into this program because it saves them so much money. It is the answer, and they know it, and they value it. The situation is that if a trainer, well, here's a real-life example. Down in Del Mar, one trainer was using an exercise rider who I think was 80 years old, okay? And he was a well-respected trainer. And another trainer who was involved in the group heard about it, and he goes over to him and he goes, you know that the risk factor with using an 80-year-old exercise rider versus using a 30-year-old exercise rider is exponentially different, and you're jeopardizing the group because you're using this guy. Well, I don't want to be any 80-year-old exercise riders applying for work in California anymore because it just doesn't make sense. The risk ratio is out of whack. So the important thing is that the trainers own the program, they control the program in California, they value it, and they operate it for the benefit of the whole, not for any individual.
Okay, I was going to ask you all, have anything else you want to add, John? Anything? Do we have any questions regarding the programs? Oh, sorry. Charlie, you had something?
I might say some people would ask us why we'd want to get involved in the horse racing industry and insuring guys that ride around in these large animals was for the reasons you heard, that the management and the buy-in and the attention to detail that each of these two groups pay, and it's been a very good relationship for us. And we've had catastrophic injuries, and we have our catastrophic medical team that works directly with each of the accounts to get these guys back to work. And but the reason that we're in this business is because of the buy-in of the individual trainer or owner in the given programs, and it's worked out very well for us, and it's a great opportunity for people within the industry to keep the industry going.
Marty, you had?
Back in Kentucky, there was a group, a trainers organization, they actually were out of Michigan, and they had a group, and I think it might have been similar, and it provided workers' comp reasonable for the trainers, and many of them took advantage of it, and they said they were all part of a group. And what happened, their losses outdistanced their reserves. And after that happened, the group came back and they required all those trainers to pay for the losses. And I wondered, is that a possibility that if it's their
Do you want to speak to how it's not with us?
they would be responsible for making up the losses?
That's absolutely correct. In California, you have to sign a joint and several liability agreement that you are jointly and severally liable for the activities of the group. So if we had a bad year and we had unexpected losses and the premiums did not support those losses, we could go back and make an assessment on the trainers that participated in that year to cover the shortfall of funds. So yes, that's a possibility. We have never done that.
And in Louisiana, by being mandatory, you don't have that risk. That's a distinct difference between our two programs.
My question to you, John, was, I remember when they used to have the captive, because we were very interested because we thought that would be a good idea for Kentucky, and many of the trainers that we had during the winter came up to Kentucky and said, this is a wonderful program, and then, but when we sat down with the individuals involved, they said you would have to have $5 million to put down initially. Now, I thought you said in your trust that there's no initial capital that has to be put up, and I'm curious, because what would happen if you have a big claim right away? You do have to let them know
There isn't any collateral that's required. Again, and that mechanism, again, is going to come from Charlie, who's the excess insurer. And then, of course, we did obviously put in money originally into the trust because you're going to need, reserves.
Start up.
But the Department of Insurance didn't require us to put up X amount of dollars. We had monies, we had $2 million left over that we moved from the captive into the self-insurance trust. But again, it goes back to that whole feasibility study. I mean, you can start out small, and it can be a trust, and then we work with Charlie's group to say, well, how much money makes sense? And again, it's, making good, fair judgments based upon a financial analysis and that feasibility study that, again, under the trust, we have no joint and several liability, but you obviously have to have reserves. But, and you just plod along, and it's a financial equation.
And that's one of our balancing act. We talk about it all the time. We have a couple of our trustees here from the workers' comp program. We're trying to balance keeping the premiums just as low as we can, but building up reserves for those times when we might have a run of bad claims that come along. We're well positioned to sustain a number of bad claims, but we're not where I want to be yet. They all make fun of me. I'm Mr. Reserves. I'm always preaching that we want to build up more reserves.
But likewise, this is just as important. This organization takes great pride in dealing with racetracks. And we probably paid more attention, as a gentleman here that took it on his own accord, for one racetrack in Louisiana to help fix the surface. We took on the fairgrounds, the last group, to fix their turf course. Well, that's a double benefit because that increases the number of entries. The more entries we have, the more premiums we collect, the more horses that race, the handle goes up. It's a mutual benefit relationship. Now, they don't always like what we tell them as far as fixing things. We have one operator that has 2 racetracks in this state that seem to be more worried about the front side than the back side. So we deal with them, and it's sometimes a little controversy, not as pleasant, but it's in the best interest of the game, of the horse, and of the people who work with the horses. So we have a very unique relationship with what we do in Louisiana in all aspects. And we're not afraid to call out a racetrack and say that your surface is too hard, your surface is too deep, you have no turf course, the racing commission should fine you, whatever it takes. And otherwise, these racinos are more interested in the front side than the back side. If they could run one race a day and give away all the purse money in one race, they'd be happy as can be. Because they feel like spending $1 on the backside returns them nothing, as opposed to spending $1 on the front side to polish up a slot machine. And so we police them, and we work very diligently and hard with our horsemen to try to get as many entries as we can with a safe surface and deal with it. I'll give you one more quick example. We have a stall shortage at one racetrack, and we just don't have enough stalls there. And you would think a racetrack would hug you to come with more horses. Well, thanks to Bernard, it was tooth and nail to get an extra 200 stalls built at a racetrack. And when you look at the stall applications, they were having 1,000 more, 800 more applications than stalls are available. Well, if you increase the number of stalls and you put more horses on the ground, you increase the entries. You increase the entries, it's good across the board. But you'd be surprised at how difficult that is to get that simple approach done. But that's what we do as a group.
You got everything you wanted, Marty? Leroy, you have that? I'll get you. Leroy?
How does it work with a trainer, say Bob Dafford is obviously in California, and he goes to Arkansas this weekend and runs?
Well, we have 3 going to Dubai, and we're covering them to go to Dubai. If Bob Baffett, who's not in Louisiana, decides to come in here to run in the Louisiana Derby, we offer what's called a stakes package, which allows them to start 1, 2, or 3 horses for a certain dollar amount. After that, he's not covered. If they come in from California and he wants to run an overnight races in addition to a stakes race, at that point, he's got to take out a policy to be covered. And there's a minimum requirement, non-refundable of that policy, and he'll be charged so much a start, and when that policy period ends, he forfeits that money. The biggest thing that we've seen with respect to trainers is in order to be covered in Louisiana, we have what's called an out-of-state and all-states policy. And if a trainer comes to Louisiana and buys a home and sets up a domicile in Louisiana, that trainer is now considered an in-state trainer, and we cover him wherever he goes except for New York, California, a few states. And so we're getting more and more trainers that want to have their all states coverage through Louisiana, through us, and they've gotten homes in Louisiana, or they've had a certain number of minimum starts, which then qualifies them for that type of coverage.
Yeah, we had one trainer who told us that the savings on workers' comp paid for the house that he bought down here in New Orleans.
So like Tom Amos, for example, he's from here.
Well,
When he goes to run in Churchill,
We cover them.
he's covered?
Yes,
we're
he is.
covering them. And we do that through, I'll let John O'Brien explain, we do that through a guaranteed cost coverage.
Right. It depends on where he employs his employees from as to whether the trust will cover it. If his employees are from Louisiana, we cover them. But we've done another agreement with Charlie at Midlands Management that if they were to employ Kentucky employees, Charlie will provide us with a policy that would cover the out-of-state employees. And again, that we work that through our insurer to make sure that when Tom Amos goes anywhere to those other states, other than the ones that we don't cover, that whoever he employs, one way or the other, we're going to have him covered. But again, a trust itself only is going to generally cover your Louisiana employees in Louisiana and while they're temporarily out of the state. If they were to hire someone from that other state, Illinois, Kentucky, or whatever, you would have to have another form of insurance. And again, that was working with Charlie and his group that we have that. It's a very unique feature.
And that's because the mechanism that we are employing in Louisiana to provide the coverage without the joint and severable liability is restricted to whatever is legally, and I always defer to John on this, Louisiana exposure, so to speak.
Same thing goes for California. We cover California's employees on a temporary out-of-state assignment.
And then when our trainers, as we call them, leave to go race in Arkansas, we do charge a higher rate when they do leave here. Our rate in-state is less than when you leave the state. But it's very, very competitive rate. Very, very, very. Yeah, I have some people that say we should charge more, but we try not to make, quote, profit. We try to build up reserves as well.
That's not true.
Yeah, we do have a stop loss. We have we have excess coverage. I mean, joint and several liability is what you were saying, or? Yeah, we buy excess insurance again. Yeah, it's mandatory. It's mandatory you have to buy excess insurance. The Department of Insurance wouldn't allow these mechanisms to exist. Right, we have a $500,000 deductible, and then we have millions of dollars of excess, again, through Midlands Management, and his is a $1 million deductible. We have different deductibles, but we each have millions of dollars above our deductible to make sure that we'll be financially solvent if we were to have a catastrophic loss. Yeah.
Well, the difference is that,
Ours is mandatory, yeah.
and theirs is voluntary. So if you belong to California and they have 4 bad catastrophic claims, and they have $2 million more in claims for the year as opposed to what they collected by way of premiums, they could assess every member, including yourself, X dollars to capture that back for that year. Whereas in Louisiana, we do not have that because we do not have the joint and solidarity liability of each participant. It's mandatory, so by being mandatory, the amount that we collect and the amount that we're able to put up in reserve, coupled with our coverage that we have.
We have $3 million of excess liability.
Per claim.
Per claim on any annual period.
So we're covered.
California's gonna have a lot more, because their larger.
Yes, for the jockeys in California, it's $100 per start. Yes. Say that again, please? I think so, but, it's what the risk indicates.
What's the, I might ask, what's the first start charge in Louisiana?
We charge $65 per start, and it's on an upgrading scale. If we basically, for every so many starts, we give you one free one, meaning the trainer, for a claim. After that, it's a sliding scale that could go up $10 or $20, which we call a probation period, in order for the trainer to get back to the number of claims per starts where he should be, or she should be.
That's the underwriting if we have someone with a bad loss history.
Right, that's our mechanism to, it's basically an insurance policy, just like if you owned a car and you get in 2 or 3 wrecks, your rates go up. And, but we encourage them to fix it and get their rates back down to where it's the $65.
And then tell them out of state.
Out of state, we charge $85 a start, no matter what state it is, as long as we cover it.
An important point about self-insurance is that it's not a short-term solution to the problem. It is the solution on a long-term basis. You have to be committed to self-insurance in order for it to work. If you think you're going to jump into self-insurance for 2 years, 3 years, 5 years, and get out and everything, don't go there. It's a 10-year minimum commitment to self-insurance because it works over the long run. The gentleman at this table here said something earlier about what happens if you get a hit, catastrophic loss, day 1. Well, day 1 needs to be day 3,650. So it needs to be spread over that many days. If you get hit with day 1, then you definitely have to look at it as in the long sense of the word. And that is exactly how Charlie looks at excess losses, is that it's over the long run. It's not like a snapshot. It's a panoramic view. So,
And that's why we pay so close attention to the number of entries per year in Louisiana, because those number of entries, if they stay consistent, we know what amount of premium we're going to be collecting, coupled with what we do get automatically from the state or through the purse structure. So when we see the fairgrounds, for example, when their turf course got fixed, increased their entries per day almost from 7, 3/4 of a horse per race, that translates into dollars to us. And it's the same token at any other racetrack in Louisiana. So while foal crops or maybe have stabilized or gone down in certain regions or what have you, we take great pride in seeing that our average start in Louisiana per race is in excess of 8. And that's a large number. And as long as we can keep that number at that level, we can provide the level of insurance at the cost we're providing it. Oh, I'll let the money man tell you about that one.
Okay. Again, we benefit from a lot of synergies. We're also the horseman's bookkeeper in Louisiana. So we have the Encompass system. I don't know who's familiar with, it's the computer system that services, I guarantee you, 95% of all the racetracks in the country. They developed a module for us, so at renewal time, our policy period runs from July 1st to June 30th of next year. The trainer must put up his deposit, X dollars, and then every time he starts, the Encompass system tracks that start all over the country and automatically deducts that from his balance. And our staff, Mike, actually oversees this operation. They'll go in and set up someone who has that situation to tell him he's going to be charged in other states and clicks off the states that we're doing business in. So it's pretty much driven automatically on the billing side, and that is fantastic for us.
So he has to keep funding his account in Louisiana.
Yes, for example, I'll use Steve Asmussen. In 1 week, if he has a busy week, he might have $5,000 worth of workers' comp entries, and he funds that, or otherwise, then it goes to the stewards, and his horses get scratched because they don't have workers' comp coverage. We apply it.
Many states will honor that. But I want to stress, Steve is not a problem.
No.
Steve pays.
No, I'm just using him as an example of the amount of starts Mr. Broberg has.
I don't want any confusion.
Well, yeah, like, for example, I mean, I can use Carl Broberg because we just looked it up. He has 540 starts in the first 2 months. And, you know, that's huge numbers with respect to being covered based on the number of starts.
Our bad accounts receivable. What we write off historically for our program is less than 0.5%. It's 85. We tend to view, and this is just our view of it, the money that comes from purses, that's what provides for the cheaper rate when in Louisiana, because that's coming from Louisiana purse money. So that's how we kind of look at it.
That's still 1% of purchase.
Yes.
California has a similar situation in that we have 0.5 of 1% from the out-of-state exotics that goes into our workers' compensation fund.
Do we have any other questions?
That lady right there. Yes, ma'am.
Couple questions. One, California, if you had, I see in Louisiana, which we had the same thing that we had, if we have a college trainer, they can come on probation. In California, do you have a way, like, we have one trainer that's probably 90% of our claims every year, that, you know, but ours is a state rep program that we tailored to the California program. Do you get rid of just trainers that come on probation or say they can't be in the program?
Yes, definitely. If they don't meet our underwriting guidelines, and that is, you know, safety practices and all kinds of other things that are in that, then they will be removed from the group. The group it's not mandatory. I mean, participation is voluntary on both sides.
That would really help us if we could do that. The other question is, what do you do in Louisiana if you have a trainer that maybe, let's say they have, you know, 5 or 6 year-olds, and they don't ever really start, yet you're covering their employees all year?
You're getting on some of my pet peeves. We also cover farms, and we apply a rate to farms of 12% of their payroll. And if they don't supply the payroll, then we won't cover the farms. That's not mandatory. That's something we do to help the breeding in the state of Louisiana. Breaking horses. We do have one individual we identified that took out a trainer's policy, and the deposit is $2,000. And from that, every time you start a horse, $65 gets deducted. Well, we found out this one individual did this 1,000? 1,000. We found out this one individual took out this training policy for 2 years and never had a start. And we identified that individual as breaking horses. So we approached that individual of taking out a farm policy. At least the payroll would cover for the risk that's at stake. That individual elected not to take out a farm policy, and so that position of a training policy without any starts per year is going to be addressed. Our workers' comp chairman is right there in the blue shirt, and it's on his list, and it is going to be addressed. There's the thing that's so disturbing to me is that we provide such a tremendous benefit to the industry in this state, and for racing outside of this state by these trainers. There's always those who try to find the loopholes, and it's part of my job, whether it's pleasant or not, to find those that try to find the loopholes and give them a chance to either come righteous, or they're going to get kicked out the program and they can get that taste. And we try with everything we can for that not to happen. But we can't allow the ones who pay the right amount to be jeopardized by people who don't pay the right amount, and they have the same amount of risk. So we police it.
I think it's safe to say that self-insurance, workers' comp self-insurance for the trainers saved horse racing in Louisiana and California.
To the level of participation we have. I totally agree with that. And we user-friendly, so.
Do you have any other questions?
Good.
Thank you guys very much for that, Pat.
Yeah, right.